Thank you for joining us on the Effort Finance, where we have weekly discussions. Like Joe mentioned in his previous video, Francois joined us and we thought it would be a little chaos with four people on this call. So we are doing a Gauteng and a Cape Town one. So welcome to the Gauteng one, which will make a lot more sense, I think, believe, in the future. But we are in Valentine's week, so um, I hope you enjoyed. Ruvan, all the best for you with your first year of marriage as well. Probably doing something great with the wife. We will maybe organize a babysitter and then go to sleep. But anyways, Ruvan, over to you.
Thank you, PJ. Um, yeah, so today I'm going to ask the question: um, do young professionals need life cover? So this is specifically for death. So this does not this is not about any other ancillary benefits like severe illness and disability and income protection and all of these things. This is only about death. Which is kind of grim, but we have to deal with it. So I think the first question that needs to be asked is why? Why do we need death cover? What's the point of death cover or life cover? What is life cover? Life cover is literally you insuring yourself. So you insure your own life for a lump sum amount, and that lump sum amount gets paid out to your estate or to beneficiaries in the event of your death. And you obviously pay a monthly premium to insure your life. So then we need to ask what's the point of it. So I think as I go into one or two of these points, uh, ask yourself the question: do you fit into this, and do you really actually need it? So let's get to the first one. So the first one is, do you have beneficiaries? So as a young professional, you probably are looking to get married or already married. You're sort of getting into that life stage. And then you should start asking the question: your wife, or maybe you already have kids, do they actually need something from you? Do they need a lump sum cash amount from you? And what is it based upon? What is it based upon? It can be based upon the cost of living. Is your beneficiaries or your spouse able to go on with their life without you being there financially? And this is also, you can also look at education. So if there are kids, if you have small kids, very important to look at what would their education cost. And it's not difficult to make these kind of calculations, and that would be then sort of what you base the amount of cover on. The second thing is debt. Uh, some young professionals do have debt, some do not have debt, some have student debt, which definitely would need to be covered in the event of death. If you don't have any debt, well done. If you're in that position, if you do have debt, it might be things like a car or a home. As a young professional, probably looking at starting a family, settling down, getting those things in order. And a thing like a house, obviously, is not bad debt, but that needs to be covered. If something happens to you, that debt needs to be settled with the bank. Otherwise, your beneficiary, your spouse, whoever, will be liable for that debt, or your estate will be liable for that debt. So the point of that type of life cover is to pay into your estate or towards your beneficiary to cover that debt of the house. So that's another thing to look at. And then this might also not be for everyone, but estate expenses, depending on the size of your estate. If you've already started, buying a home and these types of things, your estate will be a little bit bigger, and you might get into the position of estate duty, executors fees, of course, masters fees. These are expenses inside of the winding up of the estate in that process. And what some people even forget about is accrual claims. So, as a young professional, maybe you got married recently, and you married out of community of property, but with the accrual. So what does that mean? That means that if you pass away, your spouse can put an accrual claim towards your estate. That meaning that the assets that you accumulated in the marriage, if you accumulated more assets than your spouse in the marriage, they can claim half of that difference. And that's also something that would need liquidity, which could be done through a policy or through life cover. So those are three sort of situations where it might be possible, where it would be needed. But most often than not, it's not really needed for a young professional just starting out, or just starting out their financial portfolio. But it's obviously important to look at it, and to make proper planning, to do proper planning around these things. And it's important to see the correct people, get the correct advice. Some people will not be happy with the statement I'm going to make now, but it's important to be wary of let's call them brokers, that have the only intention is to make as much commission as possible. I think, ask yourself the question: if you are 28 years old, do you need 5 million rands life cover? Look at those three points that I just mentioned above. If it's not applicable, then you should not have such a large policy. It is pointless, and that's cash flow out of your pocket that could have been for something else. So it's important to keep all of those points in mind, and always remember there's a point to it. Doesn't just happen. It's not just there because you need it. What is it for? That's very, very important. Yeah, thank you, PJ.
Thank you, Ruben. Yeah, I think it's ironic. When you are quite young, you don't really need that much life cover, but it's quite cheap when you are young because of the long life expectancy and everything. So it's normally a quite cheap benefit if you're young. So maybe you can add a few million because it's cheap. But when you later on, like especially when people my age with young children, you know the importance of good life cover. And like you said, with estate planning as well, because there is not only just to pay the estate, but there's money for them to live. We know estates take a long time, or might be a few years to wrap up. But now with life insurance, that pay out quite quickly in a few weeks, so you have money to live from. So definitely something to look at. Thank you, everyone. So I'm gonna look at investments, PE ratio. So I know a lot of people, that's like the basics of investments. That they say, I remember when the first time I looked at shares, I say, okay, what's a good share to buy? Then it's normally if they have a low PE ratio. And what that means is a price to earnings ratio. If you take math, grade 5 math, it's like price over earnings. So let's say the price of the company is 10 billion rand and the earnings is 1 billion rand. So 10 divided by 1 is a PE of 10 ratio. So that's normally why that's important. And why that's an important measure is to see if you want to compare apples to apples. So let's say you want to buy uh, banking shares. So let's say you want to compare Vodacom versus MTN. So it's the same company, but both of them is trading at a 10 billion rand, but the one is making earnings of 1 billion rand. Let's say Vodacom. This is not actual figures, but just for example's sake, 1 billion rand. Then the PE is 10 divided by 1, so it's 10 PE. While on the other side, it's exactly the same. 10, you also pay 10 billion, but the earnings is 2 billion. So 10 divided by 2 is 5 PE. So it's a better share to buy, or you are buying cheaper for it. So it's not better share. So that's the thing. Normally, we would say, okay, this is a good share to buy to compare apples to apples, but it's not that easy because this one might be growing a lot faster, the earnings. So that's why normally there is a difference in PE ratios. You can't only look at that. You need to look at free cash flow, all of that. So that's why there's a whole asset management industry. But what's interesting about the PE ratio, it does give us an indication: is something cheap relatively, and or is it expensive? Especially if you compare that again in industry or historically. So I'm just gonna, if that in mind, gonna share a screen with you or a slide. Um, And this is a P/E ratio, and this is just an indication that from January 2024, just the last 2 or 3 years. And the MECI, that is just the index that I use. So it's South Africa in the green line below, and then the emerging markets and the MECI world. So this is the index. So you can see last year, beginning of last year, there was a big sell-off in worldwide equities, but especially in the US. And the USA dominates the MSCI World Index. So you can see what happened is there was a big sell-off. So what that meant is this is the P/E ratio of 18. The price got less because there was a big market sell-off, and that's why the P/E ratio went down. And now it's getting to cheaper value, and that's what you want. You want to buy in at the lower P/E ratio. So and for that to happen, there's only two things that can happen. Either the price have to go down of the share, which is not good if you hold the share or you bought the share and then the price is going down. So what you really want is you want earnings to grow. Because if, like I said, again, that example that I used, 10 over 1 billion, if it goes, the earnings go to 2 billion rand, the PE ratio went down from 10 to 5. So you want the earnings to grow. If you buy a share, you want the earnings to grow. And that is why the MSCI World and the US is, let's say, quite expensive because all those big tech companies, the Amazons, Microsofts, Facebook, they trade at very high P's. Why? Because everyone believes they're going to continue growing their earnings in the long term, and they don't have a lot of competition or a lot of costs involved. And while on the other hand, South Africa is trading at a quite low PE, especially let's say compared to historically, and there's also reasons for that. If there was no reasons, it would be exactly the same. So a lot of people say, okay, but South Africa won't be able to grow its earnings because we only have a real economic growth of 1%. So where is that going to grow come from? So that's the reason for that. What's important to note, that's the South Africa story. There's the emerging market story as well. And we always forget, we compare ourselves to the USA and the world, but we just need to know we are closer to the emerging markets. That's the Brazil, India, Turkey. And if you look at them, there's quite a big problems in some of those countries as well. China's got their own challenges as well. But you can see there's a big difference between, even if we, let's say you take South Africa out of the equation, between developed markets, the world, and emerging markets. And they said in the end of last year, it was the biggest gap this PE ratios got in the last 52 years. So only what this only tells us, this is an interesting graph, but what that tells us, that gap needs to close because we know it works in cycles and it can close only in one of two ways. Like I said, the price earnings must grow in the years more than it will grow in emerging markets, or the price should come down. So again, that's just as interesting. But what this tells us, you've got to be wary when you go into expensive markets because just know trends don't always continue. And South Africa, when we look at the markets, it look quite cheap, but a lot of people say, well, cheap for a reason. Yeah, so that's just something. This is not financial advice. It's just something to take note of, and that's why we always say diversification is important because you want maybe let's say super shares that can re-rate, but if let's say the US continues to grow their earnings, you want exposure to that as well. And we know about let's say rand weakness and everything as well. Thanks. Ruben, any comments from your side?
All good. Yeah, I think in the greater scheme of things, the normal retail investor, it's quite difficult to keep up with these things. And normally, I think most of us get our advice around the braai, which then leads us to buy into quite expensive markets. So yeah, the trend is always to buy when it's too late. So rather stick to a long-term plan and set some financial goals and just put away money constantly. Don't try and time any markets. Look at the long term picture. Absolutely.
Yeah, thank you, Ruben. I think that the nice way in the US, they call it dollar cost averaging. That's a very fancy way of saying just buy into the market each month, especially in debit orders, because that's a great thing. If you invest 1 million rand and then the markets fall 20%, that's not great. Then it's 800,000 rand. You buy 1,000 rand each month. You don't care if that 1,000 rand goes down. I don't. Then you buy in at the lower level. You just keep buying in. So I also agree with that. Just put in monthly money and you'll see it grow over the long term. Thank you, Ruben. See you again next time.